Good day, everyone. I am Andrea Gonzalez Camao. We are the Group 2, and we are assigned to present the Chapter 12 Investing in Stocks. So, here we have learning objectives. So, in this chapter, you will learn to identify the most important features of common stock and preferred stock, explain how you can evaluate stock investments and value, analyze the numerical measures that cause a stock to increase or decrease, described how stocks are bought and sold, and lastly, explain the trading techniques used by long term investors and short term speculators. Now, let's start our topic with common stock versus preferred stock. So, common stock and preferred stock are two primary types of equity that companies issue to raise capital. Both of them represents ownership in the company, but they have distinct features like benefits and risk. So common stock represents basic ownership in the company, granting shareholders right to vote on major corporate decisions and to share in the company's profits. While preferred stock, it is a hybrid between equity and debt. Preferred stock provides ownership in a company with specific privileges, particularly related to dividends and assets claims. So here, common stock and preferred stock usually confers no voting rights to shareholders, while common stock does. So here, you can all see that ownership in common stock, it says yes, because common stock represents true ownership in the company, giving shareholders a claim on the company's assets and profits. And then sa preferred stock naman, it says no, because preferred stock is parang common stock din because it also represents ownership in the company, but with different rights. Next sa cash flow, less predictable sa common stock, it is because dividends are not guaranteed, meaning nakadepende sila sa kinikita ng kumpanya, sa decisions ng board of directors, and the company's overall financial health. Sa preferred stock naman, more predictable siya because preferred stock generally offers fixed dividends payments that are prioritized over common stock dividends. Next is voting rights. Sa common stock, yes siya because they can vote on key decisions such as electing the board of directors, mergers and acquisitions, and other important matters. Sa preferred stock naman, mostly no because in most cases, preferred stockholders do not have voting rights. Wala silang masabi about the company's management or major decisions unlike common shareholders. Sa board representation naman, well represented and in control sa common stock because the board of directors, sila yung nagsiserve as the primary governing body of the corporation, which is my responsibilities na dapat align sa interest ng shareholders and management. Sa preferred stock, it's a somewhat represented and rarely in control because preferred stockholders typically have limited voting rights and influence over corporate governance. Sa dividend payment order naman, after debt holders and preferred stockholders because common stockholders bear the most risk and act as residual claimants on the company's earnings and assets na nare-receive lamang yung payment only after matapos lahat ng obligation to debt holders and preferred stockholders. Sa preferred stock naman, after debt holders because preferred stock dividend payments are subordinate to debt obligations because debt is the legal contractual obligation while preferred stock is a form of equity that carries discretionary dividends. Sa fixed dividend naman sa common stock is no because common stock typically does not have a fixed dividend because dividends on common stock are discretionary and nakadepende lamang sa company's financial performance and sa decision ng board of directors. Sa preferred stock naman, yes siya because preferred stock typically has fixed dividend because it is designed to provide shareholders with a predictable income stream similar to debt instruments like bonds. And then sa firm's obligation to pay dividends sa common stock, not obliged because for common stock, A firm's obligation to pay dividends is not obligatory because dividends on common stock are discretionary, meaning optional lamang. And again, nakadepende sa company's financial situation, strategy, and decisions of its board of directors. Sa preferred stock is obliged because because of the specific terms and characteristics of preferred stock, which make it more similar to debt than common equity. So next, um, why invest in stock? Owning stocks in different companies can help you build your savings, protect your money from inflation and taxes, and maximize income from your investment. So, um, despite these benefits, no, it is still really important to remember that investing in stock also carries risk and a possibility of losing money. So it is very essential to do your research, consider your financial goals, and assess your risk tolerance before investing. So why corporation issue common stock? Corporation issue stock as a means of to raise additional capital, and this rings especially with corporations as it helps them fund their ongoing operations and undertake new future investments. Next is types of equity accounts. There are several types of equity accounts that combine to make up total shareholders' equity. So let's start sa common stock. So, common stock, it is a type of equity that represents ownership in a company. While preferred stock, it is a type of equity that combines features of both equity and debt. Sa additional paid-in capital naman, also known as capital surplus or paid-in capital in excess of par, it is an equity account that nagre-represents amount of capital na na-receive ng company from investors above the nominal or par value of its common stock when the stock is issued. Contributed surplus naman, it is an equity account that nagre-represents amount of capital na na-receive ng company from shareholders in excess of the par value of its shares. Next is retained earnings. So this represents the portion of profits a company keeps to reinvest in its business and are key component of shareholders' equity. Next is other comprehensive income. So other comprehensive income is a component of company's equity that includes certain gains and losses that are not included in the net income but still affected the company's overall financial position. And the last one is treasury stocks. So treasury stocks, this refers to shares of a company's own stock that it has repurchased from shareholders and holds in its own treasury. Dividends not mandatory. Dividends are the payment of a corporation's profits to its shareholders. Voting rights and control of the company. So one of the primary rights of stockholder is the ability to participate in the management and control of the corporation, a right exercised through voting. So why investors purchase common stock? Simply because they can provide investors with a range of potential benefits, including income through dividends and the ability to vote in important companies' decision. So if a company performs well, you may be able to sell the stock later at a profit. Um, Income from dividends. So dividend income is the income received from dividends paid to holders of a company stock. So that's all from my part. Thank you.
Good day, everyone. I'm Michelle Jean Espiritoso, the second reporter of Chapter 12. Now let's proceed to the dollar appreciation of stock value. Dollar appreciation of stock value discuss the impact of the US dollars. Value appreciation of global trade, economies, and countries with a dollar-dominated debts. This is crucial for understanding how currency fluctuations influence stock market behavior and international investing. When the US dollar appreciates, it gains value relative to other currencies. While this can benefit US based investor with stronger purchasing power abroad. It creates challenges for other economies, especially those relying on the dollar to trade or service debts. So dollar appreciation of stock value, among iniyang pagtaas ng value ng dollars na mag-lead sang paglisod ng iban na countries sang trading na dili how dollar yung currency. What happened when corporation splits its stocks? A stock splits increase the number of outstanding shares while reducing the price per share. So, for example, in a 3-for-1 split, each 16 share is split into 3, but the overall market capitalization remains the same. Yung pag-split ng stock ng corporation kay isa ka corporate action na mag-adjust ng company share while i-maintain yung overall market value. Preferred stock. Preferred stock represent partial ownership in company but with features of both equity and debt. It typically guarantees dividend payments before common stockholders receive theirs, and investors receive consistent income in the event of liquidation. Preferred shareholders are prioritized over common shareholders, but below debt holders, preferred shareholders often have little to no say in corporate decisions. It typically guarantees dividend payments before common stockholders receive theirs. Ngandi yang investors kay yagadawat ng consistent income. Evaluate stock and investment. Clarification of stock investment. Clarification of stock investment provides a breakdown of stock types such as blue chip, cyclical, growth, income, and penny stocks. Along with their characteristics, understanding these categories is vital for matching investments with financial goals. Next is Internet. Internet explores how online platforms and resources enable AC, easy to access to stock trading, mutual funds, forex, and cryptocurrencies, democratizing investment opportunities. So yung internet kay mostly adi gayud nato masayudan yang mga information na kanato ihanap about sang pag-invest para makakwarta. Next is stock advisory services. Stock advisory services details the role of advisory services in offering financial planning, tax strategies, and investment management, aiding investors in making strategic decisions. So, yung stock advisory services na makatabang sa mga investors na maghimo ng strategic decisions. Newspaper coverage and corporate news. So the newspaper coverage corporate news discuss the role of financial news outlets in providing stock market information. Staying updated with such sources helps investor track trends and make timely decisions. So yung stock advisory services I mean newspaper coverage and corporate news. Sang mga newspaper coverage adto ya highlight yung role ng financial news outlets sang pag-provide ng stock market information. Di ba sang mga salida ya kabantay sa kamo about businesses kay mostly ang mga businessman kay maghawid ng newspaper. It is because amo gayud yang mas detailed and mas trustworthy na news bearer para sang mga businessman compared to internet. That's my part. Thank you.
So good day to all of you, especially to our instructors, Mrs. Impi De Los Santos. By the way, before I start my presentation, I want to introduce myself. I am Jimar L. Sardoma, the presenters of the other factors that influence the price of a stock market. First is beta. Beta in finance measures a stock volatility relative to the overall market. It is a component in the capital asset pricing model, which investors use to estimate the expected return of an asset given its risk compared to the market. Then, the purpose of beta is to extend portfolio management and risk assessment. Investors use beta to align their investment choices with their risk tolerance. High beta stock might be suitable for aggressive investor seeking growth, while a low beta stock is ideal for risk investors aiming for stability. Moreover, beta helps in diversification strategies by understanding how different assets contribute to overall portfolio risk. It also allows for more informed decision by comparing individuals' securities sensitivity to broader market trends. It then how to calculate the beta? This is the formula to calculate the beta. First, the volatility for a stock equals increase in overall plus beta per specific stock. Example, 10% times 1.4 equals 0.4 or converted to percentage equals to 14. Next is the book value. Book value refers to the value of company's asset minus its liabilities, representing the net worth of or equity of the company as recorded on its balance sheet. In the context of stock registration, book value per share is often used to assess the financial health and underlying value of company. It helps investors understand how much each share would theoretically be worth if the company were liquidated and all assets sold off to cover the debts. Book value is a key metric for evaluating whether a stock is undervalued or overvalued compared to its market price. However, it may not fully reflect a company's market potential or tangible asset like brand value or intellectual property. Example of book value situation. The Southwest Airlines, their asset is $23,286 million. Then liabilities 14 14,945 million. Their share stock 633 million. Then how to calculate the book value? First, book value asset minus liabilities divided by numbers of shares outstanding. Example, 23,266 million minus 14,845 divided by 633 million equals 13.33 per share dollar. The final answer. Next is the stock market bubble. What is stock market bubble? It is the prices of stocks or other financial assets rise significantly beyond their intrinsic value, driven primarily by investor enthusiasm, speculation, and market sentiment rather than underlying economic fundamentals. This market bubble often arises during periods of rapid innovation, economic growth, or loose monetary policies, when investors anticipate extraordinary returns or pour money into a specific sector or market as a whole. As prices climb, more investors join in, fueling a cycle of optimism and speculative buying, which further inflates asset prices. What is the purpose of the stock market bubble? The purpose of stock market bubble highlight inefficiency in the market and reveal the power of collective sentiment on asset valuation. In hindsight, bubbles often serve as lessons for market participants, regulators, or policymakers about the dangers of speculative behavior and inadequate oversight. Although bubbles can create short-term wealth for some investors, They often result in economic distortion and significant financial losses when diverse, leading to broader economic consequences. These events underline the importance of risk management, diversification, and focusing on fundamental when investing. Making a decision to buy, hold, or sell a stock, first evaluate its investment. To ensure that every investment aligns with your financial goals, risk tolerance, and expected returns, evaluation helps identify profitable opportunities and avoid unnecessary risks and optimize resource allocation. Next is access a professional advisory service such value, line standards, or mergent. To gain, the purpose of this is to gain expert insights and guidance in complex financial, legal, or strategic matters. Advisor can help with tailored solution or risk management and identifying opportunities that you may look. Next is analyze the firm finances. The purpose is to understand the financial health and stability of your business, or this includes reviewing income statement, balance sheet, and cash flow and profitability metrics, which are critical for making informed decisions and ensuring long-term viability. Next is track the firm product lines. The purpose of this is to monitor how products perform in the market and assess their contribution and their firm's success. Understanding product trends help in managing inventory, improving offerings, and staying competitive. Next is monitor economic development. The purpose is to anticipate how broader economic trends such as inflation, interest rates, and GDP growth might impact business and investment opportunities. This ensures preparedness and strategic adaptation to changing conditions. Last is be patient. Patience is essential in both business and investment decisions. As a result, often take time. Avoiding impulsive action and waiting for the right opportunities or market condition can lead to better outcomes and reduced risk. Then, buying and selling stocks. Primary market. Primary market is a financial market where new securities such as stocks and bonds are issued and sold directly to the investor for the first time. Its primary purpose is to enable companies, governments, and other entities to raise capital to fund their operation, projects, or functions plan. This market facilitates the flow of funds from investors such as individual or institution to the issuing entities, helping them secure the resources needed for growth, development by providing platform for initial public offerings, private placement, and right issues. The primary market plays a critical role in economic development, fostering innovation, and enabling business to thrive. Next is investment bank. The investment bank serve as financial intermediary specializing in complex financial transactions and services for raising the corporation funds, usually by helping to sell new insecure securities. Investment bank also facilitate trading and market making activities, helping clients buy and sell um, security issues efficiently. They offer expertise in financial analysis, risk management, and market insight, enabling clients to navigate the complexities of capital markets, optimize their financial strategies, and achieve their long-term goals. Next is initial public offering. What is initial public offering? Is the process by which a private company offers its shares to the public for first time, transitioning to a publicly traded entity. The primary purpose of an IPO or initial public offering is to raise capital to fund growth initiatives such as funding operation, developing new products, or paying off debt. By selling shares to the public, the company gains access to a broader pool of investors, enhancing its financial flexibility. IPOs or initial public o- offering also increase a company visibility and credibility in the market, potentially boosting its valuation. At valuation. Next is the secondary market. Second- Secondary market is where investors buy and sell securities that have already been issued and are traded among themselves rather than directly from issuing its primary purpose is to provide liquidity and a platform for price discovery, enabling investors to easily exchange assets like stocks, bonds, and other financial instruments. This market ensures that securities can be sold quickly, allowing investors to manage their portfolios and adjust their investment strategies. By facilitating the continuous trading of securities, the secondary market also helps to determine fair market value through the forces of supply and demand, contributing to overall market efficiency and confidence. Next is the over-the-counter markets. Over-the-counter markets is used to facilitate the trading of financial instruments like stocks, bond, derivatives, and currencies directly between two parties rather than through a centralized exchange. The purpose of the over-the-counter markets is to provide a decentralized platform for securities that may not meet the listing requirements of formal exchanges such as smaller or liquid assets. Next is the NASDAQ or National Association of Securities Dealers Automated Quotation. A short automated is one of the world's largest and most prominent stock exchanges. Its primary purpose is to provide a digital marketplace for buying and selling securities such as stocks, bonds, and other financial instruments. Known for its focus on technology-driven company, Nasdaq hosts many of the world's leading tech like Apple, Microsoft, and Amazon. Next is the account executive account executive and turning of brokerage firms and brokerage firms. Account executive is the serve as crucial link between a company and its client, primarily responsible for building and maintaining strong relationship to drive business growth. They act as a primary point of contact, ensuring clients and needs are understood and addressed effectively. Their role involves managing accounts, identifying opportunities to upsell or cross-sell products or services, and collaborating with internal teams to deliver solutions that meet or exceed client expectations. Next is turning. Turning are term used in the financial markets refers to excessive trading by a broker and a client account to generate commissions, often without a regard to the client investment goals or the performance of the account. It is considered unethical and, in many jurisdictions, illegal. This practice can erode the value of the client's investment due to high transaction cost. Next is the sample stock. Next is sample stock transaction. What is market order? Market order is an instruction to buy or sell a security immediately at the best available current price. Market orders are used when the priority is speed of execution rather than price. While market orders ensure fast transaction, they may result in higher or lower expectation prices in volatile markets, highlighting the importance of understanding market conditions before placing such order. Next is the physical certificate. What, what is physical certificate? Physical certificate represents the ownership of stock shares in paper form, which can be presented to prove ownership or to transfer shares. It provides a tangible record, although Its use has decreased with the rise of electronic system. Next is the straight name registration. Straight name registration is a system where securities are held in the name of a broker or a financial institution rather than the actual owner. This simplifies transaction by allowing an easy transfers and trading without the need to physically move certificates. It also ensures efficient record keeping and reduces the administration burden for individual investors. Another registration is direct registration. When we say direct registration, allow investor to hold their shares directly with the company transfer agent bypassing the need for a broker or physical certificates. These methods offers a secure, efficient way to own and manage shares without involving intermediaries. Next is a limit order. When we say a limit order is an instruction to buy or sell a stock at a specific price or better, ensuring that the investor does not pay more than the set price when buying or receive less when selling. This type of orders offers control over the price by may not be executed immediately if the market price doesn't meet the limit. Next is a stop loss order. A stop loss order is a designed to limit an investor's potential loss by automatically selling a stock once its price falls to a specified level. This type of order acts as a risk management tool. It helps protect gains or minimize losses by exiting a position when the stock price moves unfavorably. Together, these orders give investors control, security, and strategy in managing their stocks. Next, how to open an account with a brokerage firm. First, step 1. Development your investment goal. Investment goal. In development investment goal, strategy identify your investment goal which helps determine the type of stocks, investment that align with your financial objectives such as growth, income, or capital preservation. Next is step 2, establish emergency fund. It is important to establish the emergency funds include to ensure that you can handle unexpected expenses without needing to sell investment prematurely. Additionally, selecting the right type of brokerage account such as stock advantage, retirement account, or a regular brokerage account is essential for optimizing return tax benefits. Step 3. Choose the type of brokerage account that meet your needs. It is it is it is important to choose the type of account that meet your needs to optimize returns and tax benefits. Next is save some money. Step 4. Save some money. In this step, it is crucial to save money for your investment while completing the necessary paperwork to ensure that meet legal and regulatory requirements for the state to the to the investing. Last is do the paperwork. These initial steps create a solid foundation or a successful investing journey, whether registering for stock account or beginning to build your portfolio. These are the important 5 steps to open your brokerage firm when you are a beginner. It helps you to guide you how to open a successful account with a brokerage firms. Commission charges. Commission charges in a stock registration are fees paid to intermediaries such as brokerage or financial institution or facilitating and buying and selling securities on behalf of an investor. These charges are made to compensate the broker for the services they provide, including executing transactions, providing market insights, and ensuring compliance with regulation. In stock registration, commission charges are typically a percentage of the transaction value are added to the cost of purchasing or selling stocks. Example ng mga brokerage firm are the A-Trade, Charles Schwab, Fidelity, Merrill Edge, and TD Ameritrade. Minimum to open an account for the A-Trade is $5,000, Charles Schwab $1,000, Fidelity is $2,050. Then the Merrill and TD Ameritrade are $0. Their internet rates are for the A-Trade 6.95, Charles Schwab 4.95, Fidelity 4.95, Merrill Edge 6.95, and TD Ameritrade is 6.95. Next is long-term and short-term investment and strategies. Long-term techniques. First is the buy and hold techniques. It's an investment strategy where investor purchase stock with the intention to holding them for an extended period regardless of market fluctuation to benefit from long-term growth and capital appreciation. Next is dollar cost averaging. Dollar cost averaging involves consistently investing a fixed amount of money into a stock or regular intervals regardless of its price, which helps reduce the impact of market volatility and lowers the average cost per share over time. Next is direct investment. When you say direct investment, it allows investor to purchase stocks directly from a company without using a broker, often lower cost at its convenient way for individuals to acquire shares. Then a dividend reinvestment plan. Dividend reinvestment plan is a program offered by companies. Enables investors to automatically reinvest their dividends and additional shares of same stock, compounding the returns over time without the need of manual transaction. These techniques are designed to help investors build wealth steadily and minimize risk associated with the market timing. Then, short-term techniques. First is the buying stock on a margin. Buying stock on a margin allows investor to borrow money from a broker to purchase more than they could afford with just their own capital, potentially increasing both gains and losses. Next is selling short. When you say selling short, often involves borrowing shares from a broker and selling them with the expectation that the stock price will fall, allowing this investor to repurchase the shares at a lower price and profit from the differences. Last short-term investment strategies is trading option. When you say trading option, gives investors the right but not the obligation to buy or sell a stock at a predetermined price before a certain date, enabling speculation on prices, movement, or hedging against potential losses. Each of these strategies carries significant risk and requires careful consideration and management. That's the last topic of chapter 12, investment in stock. Any clarification or questions about my discussion, you can ask me directly at the school. Thank you so much.